Okay, folks, good evening. Happy Sunday evening. The markets are now open, and we have a gap up in the S&P 500. I am going to share my screen. For whatever reason, it's only showing that it's up spot 0.1%. Let me share my screen so I don't drive you crazy. And I will share this bit of an anomaly. So we're looking at the S&P 500. We closed out the session at or around 43.10. First tick up here at the open. 43.07. Something's really weird here. No, it's not today. There we go. That's better. 43.49. This is a big move up higher. Certainly not spot 0.1%. So something's off here with the metrics, but we're having a gap up on the futures. Let's see whether or not this holds. Remember, we have a lot of overhead supply immediately above. So before we get into it, we're going to be talking about, is it time to sell, folks? We have the Fed coming up. We have CPI data coming up. My guess is that volatility is going to rise this week. We have equities that are pretty expensive. We're going to go over all of that. And I'm going to talk to you about what I believe to be the greatest risk to the market. And I have a couple of examples to share with you. So let's say hello to people as the equity markets settle down here a bit. Look at Jody right out of the bat. First one with a comment. Hi, Jody. Early. That alert is working. Mr. Pete, welcome. RB, welcome. Hi, Bob. Happy Sunday. Can you cover coin, please? Yes. My handy dandy notepad. If I could find my pen, that would be awesome. What happened to my pen? What happened to my pen? God damn it. Damn it. There we go. Okay. So coin. I'm really intrigued by the futures right now. Let's continue on here. RB, I had a position on coin last week. We opened up a strangle, and then they came out with that Binance freeze of assets. I said, you know what? I don't need this nonsense from the government, and I closed out the trade right away. So I don't think that it's an investable product right now. I think the government is just declaring war. They want central bank digital currencies. You heard the SEC chairman Gensler say it himself. There's already crypto out there. It's called the digital dollar, and use that. So they're declaring war on crypto. Well, they can't do anything about crypto, but they can do something about the exchanges. So get a cold wallet. Denny, welcome. William, hey, brother. Tom Lou, hey, welcome. Jody, you impressing everybody tonight. Everybody. But she's been very, very good lately, to be honest. Very, very good. Franklin, hello, brother. IOVA. IOVA. Okay. Miss Jody, great to see you. Yes, definitely. BA. Yeah, I did analysis on BA on the week ahead commentary. And I did it on Best Stock Charts as well. It's on YouTube if you want to see it quickly. But I'll do a brief overview for you, but I already did that analysis. Okay. Jody with an awesome sense of humor. Thank you for having that. RK, I got everything in trust. Good for you. Oh, no. Oh, boy. Oh, boy. So that means it's frozen? That sucks. What a time we live in. Okay, let's get to it. Let's talk futures action. We're not up by spot 2%. This is off. It's showing that we're up by 1 point. So don't pay attention to this data here. It's inaccurate. This is a pretty significant move up higher in the futures market. Let's move on to small caps. Small caps as well gapping up. Right at resistance, right above resistance. So I know the line is a little bit off, but it's intentional. I want to create an alert. I want to see whether or not they fade this this rally. And I think that this gap up that we're seeing right now is going to be the last gap up before the Federal Reserve announcement on Wednesday. Moving on to the NASDAQ. NASDAQ gapping up right outside that Bollinger Band. This is not a 2 standard deviation Bollinger Band I have up here. This is a 3 standard deviation. And again, this is completely off. We're certainly not up by 0.01%. So a significant move up higher here on the futures. Expect a retrace at some point in time. I always do that. Okay. So at some point in time here, very soon, we're going to pull back. Look at RSI. This is only a 1-minute chart, but you have RSI at 91.22. So were I a day trader, I would be fading this rally. RSI 5-minute chart, 85.16. 15-minute chart, RSI 70, just shy of 75. Note, there's no volume here. It's just like they marked up the market. They just repriced everything. And the one thing that we need to keep an eye on, folks, is I get a report about the CTAs, the machine buying, and they're maxed out. They're 100% capacity on buying. They're holding. They're going with momentum, but they've been maxed out on the Qs and on the S&P 500 for several days now. So once this thing starts going the wrong way, you could bet that they're going to start selling, and that's when you're going to see a lot of momentum to the downside. So be careful here. It looks great, but I would be very, very careful with chasing this market up. Let's take a look at the dollar. Dollar closed up on Friday, sending gold stocks down along with the silver stocks. Not much happening here at all. Just it's holding on to support, 15-minute view. Let's check in with the euro versus yen. Euro looks weak at the open here. Looks like a little bit of a bear flag setup, which is breaking at current. Yen is weak. I'm not quite sure whether the dollar isn't catching a bid right now. It should be, but I think there's something wrong with the quote system tonight. Outside reversal bar, 15-minute chart on the yen. That's bearish. This will probably go to the downside following its trend, which is down. Let's stick with commodities for a moment. Let's talk about energy stocks. Oil took it in the teeth last week, down 2%. So I don't know what the argument is by Wall Street is to go buying stocks with a 30 handle on PE when you see oil can't keep a bid. Energy stocks did well last week, surprisingly, but despite that, oil was down lower. Usually they trade about 88% of the time in tandem. Last week was one of those weeks where they simply just didn't. And it looks as though oil is going to move lower here, down a little over a quarter percentage point. So you had the Saudis come out, I believe it was last week, saying that they're going to cut production by 1 million barrels. It was either Saudis or OPEC, one of the two. If they do that, you would expect that oil should catch a bid, which it did. And I believe it was last Sunday night that they announced this. As a matter of fact, it was last Sunday night. We gapped up higher, and I said, if they do not hold this rally, it's a big tell about the, Sunday right here. If they fail to hold this rally, it's a tell. If you get 1 million barrel cut in oil, yet the price action of oil fades, then that's telling you that you have a demand problem. It's not a supply problem, it's a demand problem. And sure enough, we are measurably lower than where we are, even at the close of not this past Friday, but the prior Friday, prior to this announcement of a production cut. So despite all the shenanigans, all the talking head nonsense that they come out with, oil is in a downtrend. There is no expectation for demand, strong GDP, and I mean strong GDP globally, not even domestically. So oil week, signaling problems, serious problems. Let's see if we could pull up nat gas. Nat gas spiked up. It's up 1.73%. We're fading off the highs of the session, but a pretty respectable gap up here on nat gas. Let's see how we close out the week. This is as of today, this candlestick weekly chart. Sometimes it's not. They don't calculate Sundays in. And we're flirting with a breakout on natural gas. So natural gas is beginning to become a bit more attractive. Jody, I know you're out there interested in natural gas, looking better, looking for a breakout here on a weekly time frame. Let's head on over to gold. Gold down $2.60 the ounce. Silver had a really good week last week, despite the dollar rallying back on Friday. All right, so silver's got a problem here. 15-minute time frame. Let me know in the comments if you know what the problem here is with silver on this chart. We'll come back to it in a moment. What chart pattern are we seeing here happen at current? I'll let you take a print screen if you want, and we'll come back to it once I get a couple of answers. All right, moving on to the weekly chart of agriculture. Corn, which had a really great breakout the week of the 29th. Consolidation week last week, and that's okay. We're holding the breakout. We've already had the retest of the breakout point, but it looks as though we have more upside to go here for corn. Soybeans, really good week last week. We were talking about ag quite a bit last Sunday night, and that it was bouncing back a bit. You had a couple of breakouts, corn being one of them, soybeans being an early stage breakout, but last week we got the confirmation, continuation move up higher. Wheat rallied, new weekly higher high, new weekly closing high, a little bit of a fade off of the highs of the week. All right, so I didn't get an answer on silver, what we're looking at here on a, sorry about that noise, 15-minute time frame, even though the weekly chart looks good, head and shoulders set up. Left shoulder, head, right shoulder, as your 45-degree neckline, which we are currently breaking. All right, I think I covered it all. Let's go back to the S&Ps for a moment. Continuing to press higher. This is still wrong. Percentage gain is wrong. NASDAQ 100. Pressing higher. Where the heck is RSI now? RSI 92.62. Okay. All right. Let's set another alert up here. I want to see if we begin to pull back. Okay. All righty. All right. So coming up this week, folks, it's going to be a very, very busy week. We have CPI coming out on Tuesday. That is the Consumer Price Index, not the Federal Reserve's favorite measure of inflation, but it's reported widely. Markets will react to it. Pay attention to this number here in particular, the core, ex food and energy. Now, the media is going to report this number, the headline number. Pay attention to the core. That's what the market's going to react to. On Wednesday, we're going to get PPI. That's the Producer Price Index. That's the measure of inflation at the producer level. Also on Wednesday, we get the Fed's rate decision. So let's talk about that. We have the markets, which are not expecting a rate hike. 71.2% probability of the Fed doing nothing. So the Federal Reserve generally delivers on what the market expects. Rarely do they not. Frankly, I don't remember a time when they didn't. Under Powell didn't do exactly what the market had priced in. So the expectation is that we're going to not get a pause. They will not call it a pause. They're going to call it a skip. That way they can make people think that the Federal Reserve is still on the job. They're going to be fighting inflation. Now, what could cause the market to continue up higher? I personally believe at this point in time that the market has pulled forward the rally in equities because the market knows that the Federal Reserve normally does what the market expects. So here's what the market expects. So why not buy stocks in advance and then sell the news? So I think that that's probably what's going to happen. What might cause that not to happen? What might cause that not to happen is if the Federal Reserve, and this is getting forecasted now by the media, and usually when the media starts floating trial balloons, doing the work of the Federal Reserve, usually it happens. And it's this, and I've spoken about this over the past several months. Expect the Federal Reserve at some point in time to move their target for inflation from 2% to 3%. If they do that, the stock market's going to rally. That's the green light, rally. Don't worry about inflation. The Federal Reserve's got you back. The markets are going to rally on that. That will allow for more fuel in the tank. If they don't deliver on that, then I suspect that we're going to get a sell the news event if they pause, or skip. Initially, we're going to get the knee-jerk reaction to the upside. Usually the knee-jerk reaction is the wrong reaction. So I would be a seller into a knee-jerk reaction of equities if the Federal Reserve does not increase the target on inflation to 3%. If they do, well, the market may still have more legs. So More to come on that as news unfolds. What else do we have coming out this week? What happened? I lost everything. Here we go. Thursday retail sales, a lot of manufacturing indexes. Watch out for these. A lot of these are already in contraction. The Empire State Manufacturing Index has been in contraction for a while now. You're seeing contraction, even down in Texas now, you're seeing contraction or a slowdown. Watching a lot of important data coming out this week. A really big pulse check for the economy. And we're going to have a whole bunch of Fed heads coming out the next couple of weeks as well. Consumer sentiment on Friday. So in terms of valuations, we were at 30.08 on Thursday evening. We are now 30.09 on Sunday evening with a mean of 17.03. So it goes without saying that the equity market is very, very overpriced and certainly not a value investor's market. So if you're buying long here for the long term and you're above the age of 35, you may want to slow down that buying. If you're young, then keep on going. You'll be fine 40 years from now. In terms of overhead supply, S&P 500, we have overhead supply at around 430.35. Where are we in the pre-market? We are way above there. They're ripping this market up higher. Wow. $4,355. That brings us up to 4,355. We're in this ballpark here. We are hitting some real serious resistance. We're right there. We are here. So where we're at right now in the pre-market is the candlestick high of Q1 of 2022. As for the triple Qs, we have resistance up at 360. They're probably going to gap us right up and into that tomorrow morning. So a very strong potential open here. I want to check the headlines, see if I'm missing something. Nothing out here that I can see missing. I think what they could be gapping it up on is the expectation of an increase in the inflation target. And then again, if they're spiking this market up in anticipation of a change in the inflation target, and they're doing it before the rate hike, then you have to expect a sell the news event. But I don't know that to be the fact yet. All right. So in terms of threats to the market, okay, so all-time highs for office vacancy rates. And I'm going to go to a chart in a moment showing the delinquency rates that are coming down the pike. Now, why does this matter? It matters because if you go back to March of this year, remember, We had a little thing called a banking crisis that occurred, and it was promptly crushed because the major banks were forced to buy out the smaller banks. So the problem has yet to get resolved, and the Federal Reserve is going to skip on rate hikes in anticipation of more problems coming down the pike for these banks because of their commercial real estate book of business. Now, what's happening is that you have debt that was taken out 2017, 2018, 2019. They need to refinance that debt. The problem is that interest rates are significantly higher than they were 5 years ago. And vacancy rates are now at all-time highs. So the value of these properties is significantly lower. So they're underwater on these loans. So the banks are going to be on the hook for this. So moving on here, this is 111 Wall Street. This is at one point in time the creme de la creme of office buildings. And now they're sitting with 21% vacancy rates and rising. And this property, they can't give the space away. And here's the blurb from the person they were interviewing in the know. I don't know of any company that's moving to the area between Water Street on the river, one broker said. I wish them well. The story of 111 Wall Street repeats across the city. Citywide problem in New York. Whether they are long-term owners or new investors, they're holding on to buildings and sweating out the big question, does anyone want to move in? Think about that. Think about yourself being the bank and you have to roll over the debt on this property. You're not going to another bank. They're not going to take on your nightmare. You're going to have to go to that same bank and work with them to try to roll over that debt for another 5-10 years. Now, this is a very popular company, real estate company, REIT, Brookfield Properties, and their long-term debt as of March 31st was $214.5 billion, not million, billion dollars. And they are now going into default on a few of their properties, mostly in LA. I'm sorry, I correct. LA and Washington, D.C. $784 million worth of mortgages and rising. And if you take a look at their occupancy rates, occupancy and interest rate hikes had hit Brookfield's defaulted DC office portfolio hard across 12 properties. Occupancy rates average 52%. Think about that. And in any commercial real estate, you've always had a certain amount of vacancy, but 52% occupancy, that's insane. They're down from 79% in 2018. That's what, 30% around there? So you have to think that the value of these commercial real estate properties are roughly 25, 30% lower than where they were, even inflation adjusted. Not even inflation adjusted, relative to where they were back in 2019. On top of that, monthly mortgage payments jumped from $300,000 to $880,000 over the past 12 months due to interest rate hikes. And here is their stock price. And folks, they're only down about 6.5% on the year. This sell-off has only just begun. This stock is a short all day long. Established downtrend channel, rising wedge formation, call it a bull flag, a bear flag setup, whatever you want to call it cupcakes. It doesn't matter. This stock is going down. It's going to go down very, very hard. And you haven't seen the hardest amount of selling yet. This is a fairly orderly sell-off, and I guarantee you that this is going to ramp up. Why? It's because the delinquency rates on commercial real estate loans, here, going back, here's the max. You can see that we had a big spike up after the financial crisis, but it began gradually. gradually enough. But when we pull into a 5-year view, you can already see it on the max view that we have a double bottom setup and we are hooking up, drilling down further, 5-year view. Look at this hockey stick up high. This is what you call a breakout. The delinquency rates have now broken out. And you drill down to a year, it's startling the level of delinquency rates that you're seeing on these books of business for these banks. The mid-tier banks are in big, big trouble. It is not over. The lending facility that the Federal Reserve put in place back in May to try to keep these banks healthy and alive overnight, they are still tapping out to the max that lending facility. When if it was all resolved, they should be using that lending facility less and less. They are still hitting it hard at the highest level since March. And on top of that, we're talking about vacancy rates here. We haven't even talked about what the impact of AI is going to have on white collar workers in the next several years. We're just talking right now about initial jobless claims as we know them due to basic economics. We got non-farm payrolls, which came out a few weeks ago, and you had the household survey, which is the government manipulated numbers, come out with over 300,000 new jobs, whereas the household survey come out with a loss of 300,000 jobs. And every week, week after week, since 2022, back here, September 2022, we have been in an uptrend on initial jobless claims, which gets reported every Thursday. And take a look at the trajectory since May the 13th. It has just skyrocketed. So what is that going to do going back to Brookfield's occupancy rates? They're at 52% now. What's going to happen when these layoffs hit and people don't need or businesses don't need that office space? Is there no sound, Pete? Is everybody hearing me all right? My mute button's is not on, so it should be working okay. So I'm going to continue on here. Can you please let me know audio check, folks? Good. Thank you. Okay. So which leads us to, I'm not an economist, okay? But I was able to understand and appreciate the impact of no doc mortgages and resetting mortgages back in 2007. And I was aware of it in 2006, prepared for it. We made money to the downside when that blew. When COVID hit and the markets are still going on a tear, I said, this is going to be a problem. I was live on air with TrendSpider, their symposium. I said, this is going to be a supply chain issue. This is not going to go away. This rally is going to fade, and a lot of people are going to get hurt. And sure enough, we had the catastrophe. Folks, this is a real event that we're seeing in the commercial real estate market. The banks are in very, very serious trouble. The reason why it's the banks in very serious trouble is because these real estate companies, they silo each property. They may use a couple of other specific properties as collateral, but they're siloed. They create LLCs. So the bank can go in and seize a couple of properties, but they can't seize the whole book of business and get made whole on that loss. So the banks are going to get annihilated here, and the government's going to have to step in and bail them out. They shouldn't. They should go under. But the government is going to go in and do what they do best, and that's spend our money. So, which brings us to indicators. What am I looking at to identify when we have a problem? So there are certain indicators that I use, the VIX, the VXN, which is the NASDAQ VIX, the SKU index, which we're going to talk about now. And all of these are based around the options market. One deals with in the money options, one deals with out of the money options. Doesn't matter the technicals, okay? Doesn't matter the technicals of how they're calculated. It just matters where they're at. And it's a level of apathy, that is very, very concerning. We're seeing it across the spectrum. I'm going to show you a few charts right now. So you're seeing in the pre-market at current, equities get bid up. Remember, we have PE above 30 on the S&P 500, and currently we have the S&P 500 getting gapped up into resistance levels. Okay, great. So let's talk about the skew index. Skew values, I'm reading the red area. Skew values generally range from 100 to 150, where the higher the rating, the higher the perceived tail risk and chance of a black swan event. What is a black swan event? Dot-com crisis, COVID, the great financial crisis. Now we have the commercial real estate crisis. So where is the skew at? I'm going to read this again. Skew values generally range between 100 and 150, where the higher the rating, the higher the perceived tail risk and the chance of a black swan event. Okay. Last tick on the skew was 155.53, going back again to reinforce the high end of the spectrum is 150. We are currently at 155.53. We can go higher. We have been higher. And the last time that we were at these levels was in the downtrend, but we hit a peak back here in 2021. What happened in 2021, June of 2021? Here's June. Let me go to a monthly chart. Here's June of 2021. The markets continued up higher as skew came off, but ultimately this got all resolved with a significant sell-off in the equity markets of 25%, a little bit more than that. 26.43% to be specific. So here we are yet again. History repeats itself. And the level of apathy here is very, very concerning. You take a look at the volatility index on the NASDAQ. The VIX is for the S&P 500. The NASDAQ has been the clear leader in terms of performance relative to the S&P 500. And to see when this market peters out, you're going to first really want to take a look at the VXN relative to the VIX. And you can see that right here at 17.5. That's where we've had historical support resistance. That's like the average of this range. And not even the average, it's the lower end of the spectrum. You have this time frame back here in 2012 to 2017 where we had so much QE coming into the market, you couldn't keep stocks down, right? But remember, now we have interest rate hikes from last year, multiple half basis point interest rate hikes that have yet to hit the economy. So this anomaly, you really need to take out and ignore. This is truly the base camp, the low end of the range for the VXN, and we are tapping below it. And we've been here for quite a while now. And note last month how VIX dropped down like a rock, VXN, I should say, dropped down like a rock, and then had a bullish reversal. Let's change this to a candlestick format. And you can see we had a bullish reversal on the month last month. And if you take a look at the volatility index, I went over this with members on the week ahead commentary. You take a look, and I'm not going to go through all the charts here. I'll go over two. One is the monthly chart. Now, this is for the S&P 500, volatility on the S&P 500. So if the VIX is going down, S&Ps are generally going up and vice versa. So we are very, very oversold here on VIX. They are hammering volatility to the point where apathy is the only word that comes to mind in my mind. We were in a compression zone. They are now breaking support, monthly support level, not one support level, but two support levels. Think about this. We have all those interest rates that have yet to hit the economy. We have a fraudulent jobs report that's out there. We have a Federal Reserve that's about to skip an interest rate increase because they're worried about the damage that they've already caused to the economy. They're probably going to increase the level of inflation that they're going to allow. GDP growth is dropping like a rock, not just here in the United States, but globally. And we have a volatility index that's at levels since just before the COVID sell-off. And the yield curve. I really don't know what to say other than buckle up, because the yield curve is just screaming. It's just screaming. There's something very, very wrong with this economy. And when it goes, it's going to be a nightmare. So for those that are new, I haven't gone over this in a while. The yield curve is a measure of the spread between 2s versus 10, 2-year treasuries versus 10-year treasuries. At current, 2-year treasuries are paying more in interest than a 10-year treasury. People don't want to go buying long of U.S. treasuries. They want to stay very short term, park their money, make their interest, stay nimble in a highly liquid asset. They're worried. This is a fear index. A lot of fear out there. This is smart money. This is the bond market, far more smarter than equity markets. So we had broken out back here. Yields began to normalize, meaning 2 years were beginning to pay less than 10 years, still paying more, but paying less than the 10 years. And we broke out. Now we're going to pull back. We're going to retest this breakout point. This is a potential double bottom setup. We've seen this before. We saw it back here in 2000, dot-com bubble. We saw it back here in 2006 both in 2006. And that was the great financial crisis. So you got to worry about the steepening. Currently, we're still inverting, allowing equities to rally up higher. But when this gets going in the wrong direction and this begins to normalize, buckle up, folks. So I titled this evening's live stream, "Is it time to take some profits?" or something like that. Yeah. You should be thinking about scaling out, making these profits real, lean a little bit to the short side, a little bit, nibble. And that's what we plan on doing this week. Let's do some chart requests. Target for Pete. TGT. Okay. Let's begin. Folks, we're going to be using TrendSpider, that is a sponsor of the show. 35% discount code below, automated technical analysis using AI, and they have a whole bunch of stuff. They're now integrated with another company. You can execute your orders off of TrendSpider. It's really cool. First up, coin. All right, so my personal opinion is that I like the company. I like them a lot. Up until a couple of weeks ago, the chart was looking really good. And in fact, it still doesn't look bad. I mean, we're consolidating here. But am I going to be able to sleep at night buying these shares, worried about whether or not the government's going to come in and seize their assets? I don't know. It's one of these companies where I think right now it's uninvestable. if you're gonna trade this long, because you can't short it, because you they I guess you could short it, but you're only going to make money. You're not going to be able to, if they freeze the stock, unless they go bankrupt, you're not going to be able to exit that trade. I don't know how that would work. The way I would trade this, if you're looking to buy it or short it, uh, I would simply go with a pretty tight uh, bull spread or a bear spread. Basically, that's buying. I wouldn't even go in the money on the options. I would go at the money option and then sell an out of the money option and just play it that way. Keep you know your downside risk before you get involved with the trade. And with options, a lot of people think they're risky, and they can be risky. But if you use them strategically, your loss, your max loss going in. Where with stock, you you really don't know that much, right? Unless you're using a tight trailing stop loss order. But what if the stop gaps down through your stop? You really don't know what your max loss is. Let's go to a weekly chart. You can't buy this. You can't buy it. They need to have their day in court. Uh, I think it's going to be dead money for a while. I don't see any reason. I don't see a compelling reason to buy this. It broke down last week. It held the breakout points. Technically, it's still holding that monthly breakout, but it's probably going to move lower. Volume very heavy. This is not a story about a company that's a bad company. It's a very, very good company. I happen to like them. I have an account with them, but it's about the government. Daily chart. I think this is a bear flag setup, and I would be looking to exit this trade on a break below this support level. Coinbase, I would have to say avoid it like the plague. And I don't feel good about saying that either. IOVA. Iovance Biotherapeutics. This is a Jody. I bet you this is Jody, right? Did Jody request this? Jody always gets me with these. Oh, no, it's Tom Lou that requested it. Okay. Sorry, Jody. Okay. Monthly chart. We broke out. Looks like we've gone over this one before. We've broken out above multiple resistance levels now. Consolidating. Monthly chart looks okay. We're down on the month, but you have resistance immediately above right here at $9.33. Daily view. It's holding on to its 21 period moving average. I think if you want to nibble here, I'm fine with that. But if it breaks down below the lows of Friday, I would probably back off of that trade, because that means it had closed down below its 21 period moving average. We may be there as well right now. We are there. We closed down below the 21 period moving average. I would wait. I would wait for this to recapture the 21 period exponential moving average, or a breakout above resistance. And this is resistance right here, this upper band. Let's call it at around $8 a share. Close above $8 a share, it'll be good. Boeing. Okay. Resistance immediately above on Boeing. I think that this is looking fairly good. I am bullish on it going into the new trading week. I do have a hurdle I want to see it overcome, and it's resistance immediately above. You had that, there's certain news events that take place, and they had some negative news event that took place recently, cracks in the fuselage, whatever the planes. And I always look to see how the stock responds. And there was really no negative reaction on Boeing. They bounced back quickly. So what that tells me is that all of these negative announcements on Boeing, they're pretty much priced into the stock and that this could be bought. So Boeing bullish on going into the new trading week. And the next chart is going to be, I need to go over. Tesla, frankly, that was on June 2nd. Um, Tesla I did over the weekend, so I don't need to do that one. Let's go over Target and ALTO. I think Target is going lower. This is yearly EMA, and we are below it right now. We're probably coming down here, 126 spot. Let's just call it 126 because it's probably going to overshoot. Volume's still heavy on the downside on a weekly chart. You have support again immediately below on Target. We bounced off of it a few weeks ago, no, a few days ago, I should say. And 126 is the number to watch. Volume rose on Friday. Pretty bearish price action on Friday. So I wouldn't be the least bit surprised to see this break. RSI at current 24 spot 77. This could go lower. It could break support. So I would not be a buyer here just yet. Closed at the lows on Friday. That's not what you want to see. We closed down at the lows of the session on volume. And you have consumer discretionary names going up like this and Target going down like this. Not good. Uh, if it's an investment, consider selling some premium on it. If you want to sell covered calls on it, that would be an option for you. Pardon the pun, but consider covered calls. You'll have to go out several months to get any premium at that strike, but that's one way to play it. All right, Alto. I don't know this company. And with those covered calls, if you decide to do them, try not to wait until expiration. The reason is that if you're in a stock like Target, let's bring it back up again. Let's say you're doing, let's say you're doing 3-month options on it, right? So you're going out 90 days. You can do that a max of 4 times, right? But if you close out that trade when those options are worth maybe 10% or 15% of what you open them up for, you could resell out another 3 months, and you could change that time frame of max 4 times per year of rolling those options to now 6 times per year. That's just by not waiting until expiration, taking profits at 10, 15% of the value of the option. So take that into consideration because a lot of times you're sitting there, the options are worth spit, and what you don't want to pay the cost to close out the trade. It's kind of silly. So uh, think about rolling out that trade earlier in the expiration cycle. Yeah, that's okay. That's okay. Good luck with the trade. All right, Alto. Okay, let's go to a monthly view. Monthly view, we're looking at a breakout here. This is not a buy, or it's an attempted breakout. We're flirting with a resistance level. I would not be a buyer here. We're right smack dab right up into resistance. Again, weekly view firming up here. We have a probable higher low on price. RSI looking really, really good here. Higher lows, higher highs. It's going to challenge this resistance level. I would look to be a buyer of the shares on a close above, let's call it, I don't know, $2.85, 90 cents, something like that. Daily view. Looking good here. I have to say, I think it's going to make a run at resistance. I'm confident in that. Does it break through? That's a big question, right? So I would set up an alert. Nice little wedge formation going on here. $2.95. You get it close above that mark. That would be sexy. So this is improving, but you have a lot of overhead supply. I wouldn't be a buyer right here, right now. If you wanted to nibble, scratch the itch, go for it. Yes, please like the video, subscribe to the channel, and everybody, folks, thanks for being here. Let's check back in with the futures. Have we pulled back at all? No. They repriced the entire market. It's not even moving now. This is just a complete reprice. There's no volume. Can we look at Tesla again? For you, yes, I can. For disclosure, I have an options trade on Tesla. We traded Tesla last week short on that extreme overbought spike up that they did. We made money there. I sold a ratio strangle on Tesla, putting us with a bias to the short side. At current, Tesla is sporting RSI of about 85. They're probably going to spike it up tomorrow morning. And on that spike up, I'm probably going to short it using a bear put spread. So expect that, members, if they do spike this up tomorrow morning, yet again, weekly chart, we had a breakout, but we have multiple resistance levels above. And the one I'll be watching for is 253 spot 46. The first one's going to be 249 spot 87. Now, here's the daily chart. So big selling come in. We closed up on the day, but we closed well off the highs of the day, and the close was not wonderful. So they gapped it up. They broke it out. It's probably going to move up higher with the rest of the market. I would not chase this stock. Let's go to a 30-minute view. Here, before I leave, RSI right here, 85. So with stocks like this that apparently can do no, they're going to gap this on Monday. Here's what I'm looking at. Wedge formation, they're gapping it up higher. So I will be looking to short Tesla on a spike up, and I don't think anybody should be buying this as an investment right now. My own personal opinion, consult your investment advisor, but please be very, very careful with chasing these stocks. Remember all the charts I've gone through showing you the apathy that's out there. There's a tremendous amount of apathy. People do not see these. There's an analogy I use of you're standing on the train tracks, you're looking down that dark tunnel, and you see a very, very small light, but growing. Now you can ignore it, or as that light begins to grow larger and larger coming down that tunnel, you can decide to get off the track. This is ever growing light down the tunnel. And there are a lot of people that are going to chase this rally up higher, and the rug is going to get ripped out from underneath them, and it's going to cause a lot of pain. Bookmark this video. Check in with me 2 weeks from now, 3 weeks from now, and you're going to see Tesla measurably lower than where we are at current. So with that, folks, everybody have an awesome night. Like, subscribe, have a profitable trading week, and I will talk to you soon. Be well.